All right, well, Groupon has $750 million in revenues last year. They think the company is worth $25 billion this year. Joining us for more on this, Bloomberg contributing editor Paul Kedrosky. Now, Paul is the editor of a business blog, Infectious Greed. Paul, let me ask you, what is that, 33 times trailing sales? You're a buyer, yes?
Oh, I'm all over this. Get me too. So yeah, there's no question on trailing revenues. It's incredibly pricey. It's above and beyond anything you'd see from some of the most expensive technology companies on the market, like a Salesforce or other software as a service firms. So the only way you're a buyer on this is if you believe, obviously, that 900 million is turning into 3 billion, which it sounds like from your reporter earlier that that's the pro forma for the year. But the issue the company has, more fundamentally though, is I like to look at sales per employee as a metric of kind of profitability and a sort of scalability of a business. And the issue for me with Groupon, what doesn't take anything away from what Andrew's done with the company, is that the company's sales per employee are probably, last year will be down around $170,000, $180,000, which is kind of old school software in a sense. It's nothing like the kinds of productivity you'd expect from sort of a next generation, cheap, fast growing technology company. And so the challenge for Groupon is it doesn't scale cheaply. It scales expensively with people.
Paul, when I look at Groupon, it's the same thing. I mean, you see a different kind of in Silicon Valley. You see invent a search engine, lots of people start to use it. All you've got to add are servers, and so there's a multiple upon expansion. It sounds like what you're saying is it's every sale, every body that works there has a couple of sales in it. In order to grow sales, you've got to grow a lot of bodies there. It doesn't have the same kind of leverage that we associate with technology companies. So do you look at it more as like a Yellow Pages kind of business or something?
No, exactly. That's exactly the way that I think that's the model you want to think about when you look at this company. And so that's going to be the difficulty for them. It's not obvious how they hit an inflection point and suddenly become exponentially more profitable than they currently are. What's going to happen is they're continually going to have to add people to grow and scale the business, and that looks more like Yellow Pages than like software than like Salesforce.com. And that for me is the problem. I mean, leaving aside that this is one of these classically high concept consumer centric companies. It's kind of like eggs pantyhose way back when, where it's like everybody knows the name, everyone says I've got familiarity with this, I've seen it, I've used it. So you get all of the sort of incredible focus on a single name stock, which, leaving aside the merits of the business, means that it's a classic, almost made by central casting, short selling opportunity for many, many investors.
All right, Paul, they say Groupon will think legs pantyhose. Sit tight. We're going to continue this conversation right after the break. All right, back with Bloomberg contributor and infectious greed blogger Paul Kedrosky. Paul, you told our Diane Anderson off the air that Groupon looked like the biggest short opportunity of all time. Really? All time?
Well, all time's pretty heroic. It looks like one of these classic made-in central casting shorts opportunities, just because, not because it's a bad business. It's actually a fantastic attention-getting business that's generated incredible revenues in a short time. But those are all the things that drive this incredibly, high and I think dangerous from an investment standpoint valuation. Again, you have to separate the business of Groupon, which has been incredible, from the valuation you're going to pay for a business that's essentially driven by and scales by adding bodies. That you have to separate gross and net revenue. Because, again, most of what's happening is this kind of pass-through revenues that flow straight back to whoever is having a coupon created and promoted. And as a result, you've got a business that it's really very easy to see how suddenly your negative cash flow, suddenly the wheels come off, you're not growing as quickly, and the valuation collapses. And that's all the hallmarks of all the great short selling opportunities over the last, well, go back to the history of capital markets. I used the legs pantyhose example. There's lots of others.
Paul, I mean, Groupon is a company that's just over 2 years old. I mean, why are they rushing to do this now? Are they trying to cash in on this enthusiasm because they think it's not necessarily going to last?
Yeah, wouldn't you? I would. So absolutely. So there's huge pent-up enthusiasm for what they're doing. There's a lot of institutional investors who found their way into many of these stocks. You were just alluding to it earlier, through secondary markets. They'd love to get some liquidity by selling at a higher price in the public markets. All of these things conspire together to say this is the time to go out. And I also argue that one of the reasons why you want to, if you're Groupon management board or investors, you want to go out now, is it's because the consumer end of this cycle is kind of coming to a natural ending with a lot of the highest profile companies coming out. And then we're going to go into a second wave where an awful lot of the next generation of tech companies are going to be selling similar products to business. And as a result, you want to go out with the Zyngas, the LinkedIn, the Facebooks, the Groupon. You want to all go out at once. You don't want to be the last guy out the door, which augurs for going out earlier rather than later.
A lot has been made of the Groupon copycats, the hundreds of Groupon copycats, but they do have this army of local sales people. Can other companies really replicate that?
Oh, sure, but I don't think that's not the real threat to Groupon, at least not the small, the Groupon of Groupons. I always joke, one day I'm going to get a pitch for those guys. That's not the threat. The bigger threat from a competitive standpoint is Facebook's experimenting now with a very similar sort of Groupon-style daily deal service. You can imagine Google doing much the same thing. The threat is someone with a comparable global footprint trying to do something similar and doing it in a more scalable way, given either existing people or better technology such that they can undercut what Groupon's doing. So, Groupon wants to go out, raise the money, buy whoever they can buy, and use the money as quickly as they can, because they see as well as you and I do that that's where the real threat is, not these smaller sort of micro Groupons of cat specialties or something. It's really the big guys that they're worried about.
Paul, you talk about shorting these companies as if they're stocks. I mean, you can't short these. It's part of the deal here because of these private market valuations being offered to accredited investors in sometimes weird ways. But I wonder, do we imagine a world where an IPO valuation is going to be below some of these private market valuations? And if you were to pick one of these companies, besides Groupon, which one's it going to happen to?
Yeah, I mean, it's a great point. And I think, Groupon's a good example of someone it might happen to. It potentially could happen to someone like Zynga. A lot of these companies, pick on these two as examples, are seeing public market valuations in the private market, largely in anticipation of being able to go public and sell out to you and I, the greater fools, who will be able to buy these things at higher prices. And it may or may not be the case. We may see a number of these very successful companies turn out to be poor investments because they're already holding public market valuations in private markets, and the calculus just won't work.
All right, Paul, thanks a lot. That's good stuff. We appreciate it. Read more of Paul's work on his blog at Bloomberg.com. And that's Paul Kedrosky, the Bloomberg contributor.